Hello, and welcome to today's presentation on Are You Prepared for the Gold Explosion in 2019? My name is Thomas, and I'll be this evening's moderator. And I want to start by extending a very special thank you to tonight's sponsor, goldeagle.com. Now, I know many of you here are already very familiar with and probably regular readers of goldeagle.com, but for those of you who are not, since 1997, goldeagle.com has been a leading research destination for investing, insights, and commentary on gold, precious metals, and even the economy in general. So we do again want to extend a very special thank you to them for sponsoring tonight's presentation. So now tonight we're very fortunate to have with us Avi Gilburt, founder of ElliottWaveTrader.net, as well as senior analysts Zach Manes and Garrett Patten, hosts of our StockWave service, which provides extensive analysis on U.S. stocks, and also our mining stocks portfolio service, which provides an intermediate term model portfolio and watch list of mining stocks. So we welcome you to ask questions and to use that questions box. You can ask questions throughout the presentation, and we're going to try to get to as many as we can at the end of the presentation. But please note that we are going to be limiting questions just to the metals markets. And in terms of individual miners, we've picked a basket that we're going to cover tonight, and we may not be able to get to any more outside of those. But we're happy to do any clarifications on those, and of course the broad general market. So starting us off tonight is the founder of ElliottWaveTrader.net, Avi Gilburt. Thank you so much for being here, Avi.
Thank you so much for starting us up, Tom. First of all, I'm seeing a few people that are saying they're having problems with sound. Can everybody hear me? I just want to try one more time. Can everybody hear? Yes. Okay, great. Excellent. Okay, well then let's get rolling, folks. Well, about a little over 7 years ago, in September of about 2011, I think it was, we caught the top in the gold market with about $6 of the actual high that was struck. And if you remember, most were certain that gold was going to power through that $2,000 level. Now, 4 years later, in December of 2015, we caught the exact bottom the night gold hit its low. And those in our trading room that night at Elliott Wave Trader can attest to that. They probably remember. And if you remember that period of time, even if you weren't in our trading room and you remember that period of time, most were equally certain that gold was going to drop through the 1,000 mark. But as we all know, we caught that bottom back in December of 2015. And once that low was struck at the end of 2015, we saw one of the strongest rallies that we've seen in the gold complex. And the GLD, which chart I have up right now, the GLD rallied 30% off those lows within about a half a year. Now, since that time, the GLD has been immersed in what we consider a second wave corrective pullback. And it's taken now almost 60% as long as the correction that began at the highs in 2011. And yeah, I know this correction has now lasted much longer than one would ever have expected a second wave of this degree to have lasted. Now, I know that many out there still believe that we're stuck in the bearish trend that started from the 2011 highs. And again, many in the market are quite certain that we're going to break down below 1,000 in gold. Well, you know what? They may be right, but we just don't believe that's going to be the case, at least right now. Rather, I don't think we'll have any indications of that potential until after the next major rally is seen in the complex. So even if we do set up for those lower lows that everybody is so certain of, I think you're going to need to see a major rally before that is going to happen. So I'm not going to address that detail at this point in time. I don't think it's going to become an issue for at least another 6 to 9 months from now, if ever. So, but those that are subscribed to our services, clearly you'll certainly have an advance heads up about this potential as we begin the next rally phase. Now, when I pick apart the pullback in the GLD chart that you have in front of you right now, When I pick this pullback apart since the highs that we've seen in 2016, this high here, we have a clear A, B, C structure since that time. And to be honest with you, it's almost textbook. Even though it's so large, it's almost textbook. And I'll explain what I mean by almost. As you can see here, the A wave of this decline was actually much stronger than the C wave so far has been. And that's evident from the MACD on the daily chart. And this is just typical of what we normally see during corrective pullbacks, where the C wave will usually positively diverge from the A wave pullback. But the question that we're all asking is the pullback complete already? And to be honest, personally, I think this structure would look absolutely perfect with a drop down back into the box. We've hit the box once already that we set, but I think it would look perfect with another drop down into this box to at least the 109 region and potentially as deep as the 105 to 106 region down here. And that would provide us with truly a textbook ABC corrective structure in the long-term structure for this, what we're calling a second wave here. Now, until about a month ago, the market was setting up for this final drop here, for this wave 5 of C of 2. The market was setting up really nicely. As you can see on the chart, we had an almost textbook ABC rally for wave 4, and then we started dropping off of that resistance, which is exactly what we would have expected for this to occur. The problem is we've now dropped in an overlapping manner. Now, it can certainly suggest that the last segment of this decline will take shape as a very choppy ending diagonal and draw out this last segment of the decline for several more months. I can't say that I'm confidently viewing lower lows in our future until we can break below this 113 support region. And should we break down below that 113 support region, again, I have a minimal target of 109, but the ideal target is really down in the 105 to 106 region. And as long as we hold this 104 level, I remain quite bullish of gold in the coming several years. Now, but the problem is, until we actually take out this 113 level, the market may begin to suggest that a bottom has been struck sooner rather than later, especially if we can break out over this high, this wave 4 high. If we break out over this wave 4 high, well, what we've got is a potential leading diagonal off the lows, and I think we'll still get a pullback after that, but I don't think that pullback is going to have a high probability of being able to break down to a lower low. It could be quite deep, but I just don't think it's going to be a pullback that would break down below these lows if we get this higher high here. So let me move over to the GDX and show you what I'm seeing on the GDX as well. Now, I think this presents a much clearer picture of the general market on the metals. I mean, at least in showing that the drop since 2016 is quite corrective in nature. I mean, as we know, we had that rally in 2016, which took GDX from 1250 up to 32, also within about a half a year. And as you can see, we traced out a very nice 5-wave structure off that long-term low. But since that time, the market has clearly been pulling back in a corrective and overlapping fashion. Now, this chart makes me much more confident that it is much less likely that this complex as a whole is going to break down below the low seen in 2015 or early 2016. But that doesn't necessarily mean that the pullback off the 2016 highs has yet completed. In fact, the pullback still looks as though it needs the dreaded one more lower low in the coming months. And that's what I'm pointing to down here. The question really is whether we remain below this high right here at 1992 and directly drop down to that lower low, or if we take out this 1990 region and get through 2051, and that points us up to the 22 region before we get that drop in the lower low. Now, as I noted before, if we get that push higher, the GLD may very well have completed a leading diagonal up. And although it can get a deep retrace, it may not break below its prior lows. But the GDX seems to suggest it will get a marginal lower low relative to the one seen here in September. Now, the other point that that this chart makes quite well is that once we do complete this pullback, the market is going to rally. Our expectation is the market's going to rally back up to the 30 region, somewhere in this region up here, for wave 1 of wave 3 off the low struck 2 years ago. But from there, we'll still see more consolidation likely. So 2019 can certainly present us with a very nice rally. I'm not so sure it's going to be as good or as significant as the rally we saw off the lows, because this rally is just going to be wave 1. It'll then give us another likely multi-month consolidation in wave 2. And that's going to be before we're set up for the really parabolic phase for the rally in the heart of the third wave, which is what will probably begin in late 2019, maybe even as late as in 2020. So while we expect a really nice rally to be seen in 2019, depending on where and when this bottoms, once this wave 2 completes, we're probably going to see one of the most parabolic rallies you'll see in the metals complex once that wave 2 completes. Now, within the GDX, we have a number of stocks that have likely bottomed in their respective second wave. But there are many others that still look like they need lower lows. Now, those that need the lower lows is likely what's going to pull the GDX down to complete its wave 2. And during that lower low that GDX and those stocks are going to get, there's still a number of stocks that are only going to pull back in a higher degree second wave, similar to what I showed you on the GLD, if we get that leading diagonal to play out in the GLD. And it's this push and pull that we've been seeing in the complex that actually has bifurcated the complex, and it's made it harder for the GDX to drop down to the ideal target we've had so far for this fifth wave in this completing this wave 2 for the GDX. An example of a stock that has likely bottomed is ABX, Barrick Gold. And for those that subscribe to our services, you would know that we caught the bottom in ABX back in this past September when we noted that the downside was fully cooked, and we expected the ABX to lead us out, to lead the market into the next rally stage, similar to what was seen in late 2015. Now, if you go back, I mean, we were so confident that the complex was bottoming out back at the end of 2015, we actually rolled out our EWT miners portfolio in September of 2015, and the ABX was one of the first purchases that we made down in the $7 region at the time. So now I'm going to hand over this presentation to both Zach and Garrett, who are going to show you some of the stocks that present as having bottomed, as well as some of the stocks which still seem to need lower lows before they strike their respective second wave bottoms. And that's the push and pull I'm talking about in the complex. You can then have a better understanding as to why the GDX has been so erratic of late. And it's really been, like I said, being pulled and pushed in different directions by the bifurcated action we see among the components of the GDX. But the main point I want to make with our presentation this evening is that the market is likely in a bottoming phase, similar to what we saw at the end of 2015, and it's likely setting up to begin its next major leg higher in the coming year or two, depending upon how long the next higher degree wave 2 here takes to form. But ultimately, we want to stress that we see this as a bottoming structure that we're seeing in the complex, again, similar to what we've seen, what was seen in 2015. And so now I'm going to hand the presentation over to Garrett, and he'll start going over some of the individual charts. Garrett, you see that?
I do, thank you.
Thank you.
All right, hopefully you should see my screen now. Do you guys see my screen?
I see your screen.
All right, perfect. So I know that Avi already discussed ABX a little bit. I'm just going to go into a little bit more detail. As he mentioned, this is one of the names that we do feel strongly has put in a bottom already to the corrective pullback that began off of the 2016 high. As Elliottians, we usually want to see all of the subwaves within a corrective structure accounted for, and that's certainly the case here for ABX. We have a very nice 5-wave move down here within our C wave of wave 2, and even the subwaves within that 5-wave move all look pretty textbook as well. Also accompanied by some very nice positive divergence on our oscillators here. And what we usually want to see within a corrective structure is the strongest technical move on the A wave, the initial A wave to the downside, which is what we have here, positive divergence at the C wave low compared to the A wave. So everything's looking very, very strongly that ABX has put in a bottom here and is not going to see a lower low, even if we do see that in GDX. And we saw something very similar back in 2015 when we put in that bottom for ABX in September here, as Avi mentioned. And then GDX and a lot of other individual miners made lower lows in January of 2016. So even if we do see a similar scenario play out here, we feel strongly that ABX has put in a bottom already. Getting a little bit more detail here on the smaller time frames, looking at the move up off of the September low, so far is only 3 waves. So the question is, do we have a setup for one more push higher here to give us a nice full 5 up off the low? Or are we going to deal with a leading diagonal? So that's basically going to depend on whether or not the November low here can hold and whether or not we fill out this final 5th wave to the upside. Again, in either case, it's still likely that ABX has put in that bottom. It actually makes an even stronger case if we do fill out that 5th wave to the upside from here. Now, on the other side of the scale, I wanted to take a look at the second. Actually, I think NEM is now the largest holding of GDX. ABX is now the 2nd largest. This is one of the stocks that argues much more strongly for one more lower low needed. As you can see here, we don't have as clear of a completed pattern down into our September low. That nice 5-wave structure in the C wave that we have for ABX seems to be missing the final 5th wave here for NEM. So as long as we continue to remain below resistance here, which is currently primarily at 34, which so far price is held below, this chart still suggests that one more lower low down to around the 26, 27 region is needed before NEM strikes its respective bottom. Now, this was one of the stocks that was able to put in its bottom earlier compared to other ones back in September of 2015. It did not see a lower low in January of 2016, but it is, in this case, making a stronger argument for needing that one more push lower here. Some of the other larger holdings in GDX I'll go through as well before I pass it on over to Zach. Starting with AEM, this one is a little bit more questionable of whether or not a bottom has been struck or not. We don't have a clearly impulsive move off of the low that was hit in September, and it certainly hasn't basically put in as much distance from that low as we have on ABX, with not as clear of a corrective pattern into that low as well. So kind of on the fence here, this one could go either way. If we start to fill out higher as the wave 3 of this leading diagonal, basically all that's required is that you finish off the 4th and 5th to confirm the bottom. If not, another drop down in between these 2 fibs here, the 618 and 764 retrace, between around 32 and 27 is possible for lower low in the wave 2 on the AEM. AU, similar to ABX, is one of those charts that seems to be making a fairly convincing argument that a bottom has been struck for the wave 2 on this chart, another larger holding in the GDX. It also saw a fairly deep corrective pullback off of the 2016 high, retracing almost about 80% of that entire rally off the 2015 low. So it doesn't really even have as much room to see another push lower while still maintaining above that 2015 low. So actually good in that respect that it seems to be providing evidence that a bottom has been struck. Similar to ABX, though, would look even more convincing if we were to push a little bit higher here up into around the 1150 or so region in a micro fifth wave off of our August lows. This would be 1, 2, 3, 4, and 5 to give us a nice five-wave structure off of that low and further confirm a bottom. And then, as Avi mentioned, even if some of the GDX stocks turn back down and reach lower lows, ABX and AU and other charts that look like they have put in a bottom can just give us a corrective wave 2 pullback. We also do see the potential for some rotation in the miner sector. Kirkland, we used to joke about in our miners portfolio service that it was the honey badger of the entire complex, since basically when everything was going down, this stock continued to outperform in our portfolio and continued to give us really nice gains as it basically just continued an uptrend throughout this entire downtrend in the larger complex. However, we've filled out, according to Elliott Wave expectations, basically a pretty decent sized third wave here up into relatively normal Fibonacci extension resistance that you would expect for a third. So it's really making an argument that unless we get maybe one more push higher as a slight extension, that Kirkland needs time to consolidate as a fourth wave and certainly could see some rotation away from previous leaders in the complex towards some of those ones who were hit hardest on the downtrend. BVN, another one similar to AEM that could go kind of either way. We've put in a decent amount of distance since that low that was struck in August. However, it left a little bit to be desired as far as the pattern into that low. Normally, you want to see a C wave, even if an expanded flat or a running flat equal roughly the same length as the corresponding A wave at the same degree. In this case, it just isn't the same size. It's a lot shorter than that A wave to leave room for this red count as reasonably valid. The structure off of our low here in August is also fairly overlapping, so that leaves us without a clear impulse, making us rely on a leading diagonal if it has put in a bottom. So another chart that could go either way, but if we get further confirmation that this has put in a bottom, I have no issue really trusting the blue count with that wave 2 already complete. And then the final chart I wanted to look at was KGC. Certainly hasn't seen nearly as much action off of the more recent lows since it continued to push lower following that larger bounce that we saw in other stocks back in September and August, but has since reached fairly significant fib support. Measuring the retracement of this move up off the 2016 low into the 2016 high, the 618 retrace is a very common target for a corrective pullback as a wave 2, and we came just a few cents shy of reaching that. It was at 232. The bottom we hit was at 238. We also have another very important fib at 243 that was struck, which is the measured move relationship between the initial wave down here as wave W and this more recent Y wave. In ABC or a WXY corrective structure, we most often see the A wave and the C wave, or the W wave and the Y wave, have equal proportions once that corrective structure completes. So as you can see, there are a few charts out there that can argue for a bottom in place, and certainly likely have already struck a bottom. Even if we do see lower lows in GDX, they can just get a corrective pullback that holds above their low that was already struck, and some other names that do argue for further downside still needed. So that was kind of the push and pull that Avi was referring to in the GDX and larger complex. So with that, I'm going to pass it over to Zach, and he has a couple of ratio charts to go over with you guys. Did you
Can you guys see my screen and hear me?
Yes, I can.
All right. Very good. So apologize for my voice. I'm trying to get over a cold, or maybe just coming down with a cold, I'm not sure. But one of the things that I like to do, in addition to working with Garrett in stock waves and in the mining stock service, and just being a general analyst in the main market section, is look for a story to tell, and sometimes kind of skirt the edges where fundamental analysis might meet technical analysis. So we really don't put a lot of emphasis in fundamental analysis, but to the extent that I'm willing to go, most people will say that the miners, gold and silver mining companies, and maybe some copper mining companies, probably do have some relationship to the price of gold. Most of them have pretty set fixed operating costs to produce each ounce of gold. And so the dollar value of each ounce of gold really does affect their margin a lot. I think almost every company, with the exception of some newer exploration companies that don't yet have mines, most companies have their operating costs, all-in sustaining costs, in the 900s, if not below. Very, very few companies are over $1,000 an ounce is their cost of production. So when gold is $1,200 an ounce, their margin is maybe only about 20%, unless they've been around like Barrick. I think Barrick is almost under 600 for their all-in sustaining costs. But this is a ratio chart of gold to the miners index. And when I talk about miners index, rather than just looking at GDX itself, which is more limited with only some of the larger companies, looking at the HUI, which is the Amex Gold Bugs Index, which includes a lot of the micro and smaller cap mining stocks that we follow as well. And the thing that I think that this shows the most is that as the price of gold starts to come back up, you get a much more explosive move out of the miners than just a normal dollar for dollar or percentage. And it's not like it's just a regular 3x or 2x that you could say, for every amount that gold moves, the miners are going to move this much more. But I think that there's something that kind of magical happens when gold crosses over the $1,300 threshold, and we're getting very close to that again, as Avi had talked about with GLD, with gold holding in the 1,200 region for support, and maybe dropping down to test 1,100 again. But if we can hold the recent lows in the 1,200, the low 1,200s, and head higher, that move can come into this wave one pretty quickly. On charts, there are many charts like this in Elliott Wave that we don't project as a more linear progression for fibs, because particularly things like ratios and oscillators, you can apply Elliott Wave counts to them, but you have to make some concessions, and usually things are going to oscillate between a lower price extreme and an upper price extreme, and going to move in three-wave moves. So we have here from a significant bottom that was struck for this gold to miners ratio back in 2003, a clear ABC move up into what is the highest level, right around 11, that my chart goes back to, that has on my chart. So this previous high was only about 760 here, and we have a sharp move down, which is an initiation move and a corrective retrace, and looks like we are set up and starting this C wave down, which if we draw fib support, takes us back down at least towards maybe about the 390 to 350 region, or 340s, and possibly extending down into the lower twos, showing that on this move, where we do expect both gold and the gold miners to move higher, that the miners should be outpacing that move and getting much more explosive gains in value over just the regular gains in gold, which should be pretty stellar as well. So that was one chart that I like to look at, and that is just more of a plug for, it's not not all of the miners are going to move all the same. As Garrett was showing you, that we certainly see potential for some rotation. And then among those miners, we have a couple of names that we've keyed in on that have tremendous exponential growth potential. And so we're going to continue to track those, and they will occupy solid spots in our portfolio. The other thing that I wanted to take a look at is the miners in relation to the general market. So, not to say the bad word, the C word that Avi hates as far as correlation, but we are expecting, there is kind of an ebb and flow, and that miners, while they are regular stocks in some sense, they are very different than regular stocks because they're tied to gold, which is often seen as a safe haven when the market declines. And those of you who are on our other webinar a couple of weeks ago will remember that we think that we're in the early stages of a larger primary degree wave 4 correction in the S&P 500. Which should take us down towards probably the 22 to 2100 region, and we'll be able to zero in on a target as we get further along. But it's going to progress in probably a longer term choppy manner as a bigger wave 4. During that time, the S&P to the Huey index, we again see a corrective rally. It did make a nominal new high, but as a B wave, after a clear 5-wave up move from off of this would be the 2011 September high that gold made, as well as the market continued to rally during that time as well. So you had gold making a significant top, and then the S&P continuing to rally off of its March 2009 lows, giving us 5 waves up in that ratio. And then you can see that from the 2015 low, despite the 2015 lows in gold, despite the rally in the market, gold has moved more in relation to the market, causing this ratio to fall, which looks like an initiation move of just an A wave down off of as part of this retrace, only getting to the 382. So looking for a wider expanded flat with a larger C wave coming down in the Huey ratio fits in line with a larger correction in the market and with a more explosive move starting, as Avi mentioned, in gold. So I think that ratio, this 6 region really looks like an ideal target because you have the support from the Fibonacci fans. You have kind of a good Fibonacci relationship between the A wave and the C wave here. And then you have this 50% retrace, but could certainly see this extend down and get closer to the 618 Fibonacci retrace of this move up, which is down closer around the 4.59 region. And lastly, before we turn it back over to Garrett or Avi for you guys to ask some questions, is just looking at the S&P in relation to gold itself. And here we can also see this 5-wave move up from the 2011 low, where according to the ratio, the ratio bottomed just under 60, and when mostly that's due to the top that was struck in gold in September 2011, and that rather than being a B wave high that we had in some of the other ratio charts, this looks like more of a 5th wave extension in the S&P to gold ratio. So after 5 waves up, Elliott Wave says we should always expect at least a 3-wave pullback. And again, when you're talking about longer term ratios and oscillators, we don't really necessarily look for full linear projection of a possible wave 2. And that's why I have this larger ABC here. That could be a much deeper retrace to get it back down to more extreme bottoming levels before it comes back up into a high region as well. But for all of these charts, we have a nice initial move off of the most recent turns. So that should be starting at least this larger A wave that could correspond to the larger wave 1 that we saw in some of the other charts and that Avi showed you on the GLD. All right, with that, I'm going to give it back over to Garrett, and you guys can ask some questions.
I see a question on here about whether it's good for a long-term investor to get into the GLD and GDX. Quite some time ago, I did a webinar going through the prospectus of the GLD and highlighting a number of reasons why anybody who is serious in being long for the long term in the gold market should not, I will say that again, should not be using the GLD as their long-term investment proxy. There are way too many flaws inherent presented in the GLD prospectus that would suggest you utilize the GLD for a trading vehicle and not an investment vehicle. I want to be very clear about that. I view the GLD as a trading vehicle and not an investment vehicle. And I think we have, Tom, I think we have that webinar in our library, and anybody can come in and see it. You don't have to be a member, I think. Is that right?
I believe we do have it available publicly, but we can also put a link into the follow-up for everybody, because we are recording this, and we will send you a link to that, so we can include a link to that presentation as well.
Okay. Now another question, guys. We could sit here literally for hours going through charts and discussions. You know, we've chosen to limit the discussion tonight, so at least we can remain somewhat focused. So we're not going to be going through all the different charts that you guys are asking us individually about. You know, if you want, you can add, we have the opportunity. You guys can ask Garrett or Zach inside our trading room specifically for any stock you want. But we've chosen only a handful of stocks to highlight tonight, just to show you, you know, that either, you know, major stocks have either bottomed or just need a lower low. So if you're asking us, you know, have we bottomed? Well, it really depends on what you're looking at. So I cannot tell you, we can't tell you that, yes, the market as a whole has absolutely bottomed. You have a number of stocks that have bottomed, and you have a number of stocks that have not. So if you're asking us, have we bottomed? The answer is yes, and the answer is no. So please understand that. The market is very bifurcated in a very similar fashion that we saw in late 2015. In fact, in 2015, we saw some stocks bottoming like the ABX in September of 2015, whereas the GDX did not bottom until January of 2015. So, you know, if you're asking us, have we bottomed? Well, I'll tell you, the answer is yes, and the answer is no. So, and the other thing is, we're not going into silver tonight, and we're trying to really, really stay focused. So if you guys have questions about what we focused on tonight, we're more than happy to spend maybe another 10, 15 minutes answering questions.
You know, Avi, sorry about that. One question I did want to interject, because I'm seeing it come up a couple times, and I know we're coming off this long wave too, and it's about leverage and people getting excited about the potential opportunity in using leverage then to take advantage of that. Do you have any thoughts or opinions about that strategy?
Oh boy, do I have. For the last several years, I have been warning each and every one of our members that has been willing to listen to stay away from leverage in the metals complex until a 1-2 structure actually validates and provides us with the breakout. Once we have a valid breakout confirmed after a 1-2 structure in the complex, at that point, I know I'll be going leverage long on a number of things. But until we actually get that set up, you really should stay away from leverage. And leverage is what has killed people during this last 2-year consolidation. Despite our warnings over and over and over, if I haven't warned about it on a weekly basis at some point, I haven't warned about it at all. I mean, we have warned about it ad nauseum. So again, stay away from leverage until the market confirms the breakout. So that's pretty much what I've been saying for years, and I still hold to that.
Garrett, I think I cut you off. I apologize if I did.
I was just going to say a quick note for those requesting individual charts. The first Monday of every month, we do our Miners Portfolio webinar. So that will be next week. If you want to sign up for the service and give it a shot, and we'll have that video and be taking any requests during that webinar next week.
That's a great point. And about how many charts do you cover during that video, just to give people an example of what you're going to be covering?
Well, we go through all the portfolio holdings and then take requests, so it's definitely up there in the dozens, if not higher. Yeah,
we're talking 50 plus stocks, trending an hour and a half presentation. So it's a very in-depth presentation. If you're interested if you need any help getting started, you're welcome to go to ElliottWaveTrader.net. You can use the contact form and email in, and I'll be more than happy to help you get started before that presentation gets off and running. So just, Avi, did you happen to see any, actually just while we're still on the Miners Portfolio service and that webinar that the guys do, that Zach and Garrett do, through also day in and day out throughout the day, users are welcome to submit questions to the guys asking for analysis on stocks that they're interested in. And that does not have to be mining stocks that they're actively following. As long as they've got a data feed on it and they've got a good chart to do a mock-up on, they're more than happy to give you their insights on anything that maybe is of interest to you. So that's something else to also think of. The service is not just a weekly webinar. It's a daily discussion about mining stocks and potential setups.
I see one question of somebody. I want to address this. Somebody's asking me, what are the key factors we see that are going to affect gold in 2019? Well, I want to ask a question to everybody here. How many of you got aggressively long of gold after QE3 was announced? I'm curious. How many of you assumed that QE3 was going to be a major boon to gold? Because I will tell you, most of the market did. And I would probably say 99% of the articles out there were strongly suggesting that QE3 was going to cause gold to go to the moon. For those that were with us at the time, you would know, and I know when I wrote public articles about this, we shorted gold not long, or at least we suggested to short not long after QE3 was announced. And I remember I actually had people say to me, people post to me, I'm throwing away my career as a metals analyst to make such a suggestion. I'll never forget that comment. Guys, when it comes to the metals, factors are not really what you want to consider. What you want to consider is market sentiment. When it gets overly bearish, you want to be long. When it gets overly bullish, you want to be out. It really is that simple. The question really comes down to, how do you track how bullish and how bearish market sentiment is? And that's what we do utilizing Elliott Wave. It tracks market sentiment, and Elliott, back in the 1940s, identified that markets move in 5-wave structures during a bullish move and 3-wave structures in a corrective move. So that's how we track market sentiment. So when it comes to factors, folks, you won't hear us talking about factors. We're rather much more concerned about price and what price is telling us about the market. And overall, we're usually a lot more accurate than those that are following factors.
Avi, you touched upon this briefly, and just in case some of these questions are coming in, maybe some people came in a little bit later in the presentation. If you could just repeat again about the question in particular is the chances that we don't see a monster rally before maybe say another pullback in gold, say a larger pullback than the one we highlighted on the charts. You kind of mentioned that the potential for that being in place, but that'd be something that you would expect to see a much larger rally first before we would then see something along those lines. Could you cover that again, just for anybody that came in a little late?
Effectively, what we're looking for, I mean, there are many people out there that are expecting us, especially if we break down now, especially if GLD now breaks down below 113. I can assure you that a significant amount of the market is going to expect that gold is going to drop below $1,000 again. We think that the likelihood of that happening in a direct fashion from here is very low. And as I said, as long as the market holds over that 104 GLD level, we are going to maintain a very bullish perspective, even on a drop down to 105, 106, which at the end of the day really is my ideal target on the bottom on gold, on GLD. But no matter what, as long as that 104, 105 region holds, folks, we see the potential of a very big rally coming up. Is that rally going to take us to new all-time highs immediately? That's yet to be determined. Our expectation is that once the bigger rally in late 2019 and 2020 begins, that's our expectation. But until that rally actually starts taking hold and developing through 2020 and 2021, we will not be certain if it's going to be pointing us directly to all-time highs. We'll know, again, a little bit better as the pattern develops. Yes, I know that there are certain programs and people that are looking for below 1,000 right now. And they were the same people that were looking for below 1,000 in 2015 and again in 2017. There's nothing new under the sun. People that are bearish are going to remain bearish. People that are bullish are going to remain bullish. We're neither bullish nor bearish. We look at the market as the market presents to us. We don't have a bias per se. The price tells us, and the price action and the price structure tells us whether we need to be bullish at a certain point in time or bearish at a certain point in time. It's really that simple. I remember when people were so angry at me, through 2013 and 14 and 15, when I maintained a bearish bias in the overall complex. And then when I turned strongly bullish and I said, I'm now changing sides towards the end of 2015, people thought I was nuts, because at that point, everybody was certain we're going lower. Folks, we don't look at the market in the same way most do. We really, really just view it in the most intellectually honest perspective we can, based upon price and market sentiment and what price is telling us about market sentiment.
I see a question here. It's a phrased as a more general Elliott Wave question. And I do think it's a very interesting question, and it's talking a little bit about liking the methodology, but struggling to use it to actually find trades actively. And of course, for those of you that don't know Avi's history, we won't rehash it all, but Avi's kind of worked his way through many different methodologies, and he's come to Elliott Wave and also his Fibonacci pinball method, which you can learn more about on our website. It's just in our education section for free. You can read about it and see demonstrations about it. And believing that is the best way to look for and find ideas. So with that kind of question in mind, I did want to note that with that mining stocks portfolio service, if you are someone that is looking for a little bit more of some direct action for somebody else that's saying, okay, this is a pattern that we like and that we think could be very promising, the mining stocks portfolio is a model portfolio of trades that they'll be putting out that you could choose and kind of review and see if you want to follow along with. I also wanted to note that in our education section, there is a webinar series. Part of the webinar series is available to the public. Another part of it does require a subscription to access. I think we just kind of cut it around in the middle. But in one of those webinars, Garrett, it's a webinar series that Garrett did, and he actually goes over how you can use the pattern and Fibonacci levels to look to isolate specific trades. So that is also something that we have out there. And I thought, since we did have a few more minutes and we are looking at his charts, I thought maybe Garrett would give us kind of a short primer of how someone could take a chart. And actually, I know we're getting the benefit of looking at hindsight here, but what you'd be looking for as a pattern starts to play out, what you'd be looking for in a trade.
Sure, yeah, I can go over that briefly. As you mentioned, one of the most powerful tools that you can utilize with Elliott Wave theory is that Fibonacci pinball method. The most common mistake that I tend to see for people just beginning Elliott Wave theory is they tend to label or count either corrections or impulses as complete before they actually are. And that's where the Fibonacci pinball structure comes into play to really help you use that Fibonacci pinball method to kind of confirm or deny whether or not you have a completed impulse. So what you're normally looking for a good trade setup is a 1-2 in either direction, usually to the upside, since most markets are going to be trending to the upside. But you're trying to catch that wave 3, which is the strongest portion of an impulse. As you can see, the heart of a third wave during our move up in ABX off of the 2015 low obviously was where the quickest gains were made and the strongest portion of the trend occurred. So that's kind of where you're trying to catch those nice trades, those trending moves as a third wave, and therefore you want to identify when you have a 1-2 setup to the upside. And so that's what we're kind of looking at as the possibility at a higher degree here, this larger degree 5 up being a larger degree wave 1, and then the corrective ABC pullback as our wave 2. So obviously going to take much longer if this is a 1-2 setup to the upside to play out and fill out that entire third wave. But you can see that we have a similar setup just at a higher degree to what we had back in 2015, and we'll be using Fibonacci pinball as the price structure fills out for that third wave to identify when those specific turning points, when we're going to get a fourth wave consolidation within the wave 3, when we're going to get the higher degree fourth wave consolidation, etc., when those turns are most likely to happen.
And these key reference levels, obviously where you have the labels, but these key reference levels can act as, now we know where our stops are. As we're trading along, if we're trading a pattern, let's say we think it's at that major degree wave 2, there are other stops that potentially we could use throughout the way that would be concerning, but at least if nothing else, you know a key reference level that you're going to use as say, a potential stop for any long trade or short trade.
Right. So there are specific rules associated with Elliott Wave theory that you can use to confirm or deny your expectations. One example of a rule would be that a wave 2 pullback cannot exceed the starting point of wave 1. So if this current pullback were to drop below the September low, I mean, very obvious that a bottom wouldn't be in place, but it invalidates the 1-2 start off of that low. And the same situation would be if we were to drop back below the 2015 low. Obviously not what we're expecting, but just as a reference to using those rules for stops. As well as when you're in the heart of a third wave, typically when you cross above the 618 extension of measuring based on the size of the wave 1 projected from the bottom of wave 2 is how you apply Fibonacci pinball. But usually when you cross above that 618, reach a 100% extension, you don't want to see price ever cross back below that 618 extension. So often for trading purposes, you can use a stop underneath that level to protect profits.
And what we use Fibonacci pinball for is we're constantly moving our stops up through the progression through the Fibonacci pinball pattern, and it allows us to continually move our stops up to these next Fibonacci levels at which we should not break down below as we move through the progression.
Right, and Avi, I don't want to butcher your statement, but you oftentimes will remind people trading is about probabilities, not absolutes. So, or something along those lines. And I always try to remember that myself. You're trying to put as much in your favor And that's something that Elliott Wave and I think the Fibonacci pinball does.
Exactly.
Just also a kudos to Zach and Garrett since they're here. Although some people forget, Avi is also a mining stocks portfolio analyst as well. But Zach and Garrett do a lot of the heavy lifting in the room, and they're just some members are appreciative of it, especially some of the hedging that the portfolio will do as well. If the guys do see an opportunity where we could be seeing some downside, they've actually been putting out some hedge trade ideas that you can utilize should you so see fit to help protect yourself to the downside while you're holding a portfolio of names that you really do like. So, we're coming up on the half hour, so I kind of wanted to give Avi an opportunity to maybe kind of button everything up for us here and kind of send everybody off this evening with what you think is most important for them to remember and go forward with.
As I stressed right before I handed it off to Garrett, guys, what I want everybody to recognize is that the overall complex is in a bottoming structure. There are certain stocks that have bottomed, that have likely bottomed. I'm not going to say anything definitive, but there are certain stocks that have likely bottomed, and there are certain stocks that have likely not bottomed. That's going to see a lot of push and pull that we're seeing in the GDX, and why the GDX looks so jagged and overlapping. And that's probably going to continue until all the stocks that we're tracking do finalize their bottoming structure. How deep the GDX is going to get, that's going to be a question of which is going to push and pull more on the GDX. But as we said, there are a number of stocks that have bottomed, a number of stocks that have not. The GLD has still not given us a clear indication as to whether it has bottomed or not. We expect we'll probably see that answer over the next week or so. That would be my expectation. So ultimately, what you have to walk away from this is recognizing that the market is likely in a bottoming phase. And with that bottoming phase, you want to be looking at getting back in and starting to buy up some of the opportunities that are out there, especially on the next pullback that we're going to see in the complex. You'll probably only get one more opportunity, as I showed you, potentially in late 2019, mid to late 2019 would be my expectation as to when you'll get one more opportunity to leg into the complex. But legging into the complex at that point in time will likely be at a higher level than we're in now. So ultimately, please recognize and go away from this recognizing the market is in a bottoming structure. And you want to start looking at what you want to buy, where you want to buy it, and so on and so forth. And from a long-term gold perspective, please stay away from the GLD as a whole. GLD is a trading vehicle, not an investment vehicle. If you want to own gold, buy gold. Okay?